Imagine this. You finally decide to invest. You open an app. You buy a few stocks. For a moment, you feel smart, responsible, like you're finally getting your financial life together. Then the market drops. Not a little, a lot. Your portfolio turns red. Your stomach turns with it. You start checking prices every hour, then every 30 minutes, then every 10 minutes. You can't focus. You can't relax. You can't sleep. And suddenly you're wondering, did I just make a huge mistake? If you've ever felt that way, this video is for you. Because here's something nobody talks about enough. The best investment strategy isn't the one that makes the most money. It's the one you can stick with. Because an investment plan only works if you can actually live with it. Today, you'll learn how to invest without constantly worrying about market crashes, scary headlines, and daily price swings. By the end of this video, you'll know how to build a portfolio that helps you grow wealth, without losing your peace of mind. Let's get started. Most people think they're afraid of losing money, but that's only part of the story. What they're really afraid of is uncertainty. Nobody knows what the market will do tomorrow. Not the experts. Not the economists. Not the people on television. Nobody. And humans hate uncertainty. We'd often rather know something bad is coming than face the unknown. That's why market crashes feel so painful. Not just because money is disappearing, but because control feels like it's disappearing too. The first step toward investing peacefully is accepting one uncomfortable truth. You cannot control the market. You can only control your behavior. And surprisingly, that's enough. Because your behavior matters far more than your predictions. Imagine entering a chess match against a grandmaster. Would you expect to win? Probably not. Yet every day, millions of people try to beat professional investors. They chase hot stocks, latest trends, viral investment tips, secret opportunities, and most of them lose. Why? Because they're competing against people with more information, more experience, and more resources. Here's a simpler approach. Stop trying to beat the market. Own the market. Instead of betting on individual winners, invest in broad market funds. When businesses grow, you benefit. When innovation happens, you benefit. When economies expand, you benefit. You don't need to predict the next big winner. You just need to participate. And participation is much less stressful than prediction. Every day the media needs attention. Attention creates clicks. Clicks create revenue. And fear gets attention. That's why headlines sound like this. Market crash coming. Recession warning. Investors panic. The end of the bull market? Notice something? Nobody writes, market behaves normally today. Because that's boring. But boring is often exactly what successful investing looks like. The market has survived wars, inflation, political turmoil, financial crises, pandemics, and countless predictions of doom. Yet long-term investors who stayed invested were generally rewarded. The lesson? Don't confuse headlines with reality. News is designed to keep you watching. Your investment strategy should be designed to keep you calm. Imagine planting a tree. Would you dig it up every day to see if it's growing? Of course not. Yet that's exactly what many investors do. They check their portfolio constantly. Every dip feels catastrophic. Every gain feels temporary. Their emotions ride a roller coaster. Research has shown something interesting. The more often people check investments, the more risk they feel. And the more likely they are to make bad decisions. Why? Because short-term volatility looks scary, even when long-term progress is perfectly normal. A simple solution. Check your investments less, not more. Once a month, maybe once a quarter. Your portfolio doesn't need your daily supervision. It needs your patience. Many people invest too early. That sounds strange, but hear me out. Imagine investing all your extra money. Then your car breaks down, your roof leaks, or you lose your job. Now what? You may be forced to sell investments at the worst possible time, not because it's smart, because you have no choice. This is why an emergency fund matters. It's not just cash, it's emotional protection. It's what allows you to leave investments alone during difficult periods. Without emergency savings, every market decline feels dangerous. With emergency savings, downturns become easier to tolerate, because your survival doesn't depend on today's stock price. The secret of automatic investing. Let's imagine two investors. Investor A studies charts, reads news daily, analyzes every market movement. Investor B invests automatically every month. Who wins? Surprisingly often, Investor B, because consistency beats brilliance. Automatic investing removes emotions. No guessing, no timing, no fear, no excitement. Just steady investing month after month. Markets rise, you invest. Markets fall, you invest. Markets crash, you invest. Markets recover, you invest. Eventually, something amazing happens. You stop worrying, because investing becomes a habit instead of a decision, and habits are easier than decisions. The cost of waiting. One of the biggest mistakes investors make isn't losing money, it's never starting. They wait for the perfect moment, the perfect economy, the perfect opportunity, the perfect market condition. But perfect rarely arrives. Think about this. If someone had waited for a time when the economy felt completely safe, they might still be waiting. There is always something to worry about. Always. Yet history shows that time in the market has generally mattered more than timing the market. The longer your money works for you, the harder it works. Waiting feels safe, but waiting often has a hidden cost. Missed growth, missed opportunities, missed years. Understand what volatility really is. Here's a mindset shift that changes everything. Most people see volatility as danger. Successful investors often see volatility as normal. Imagine owning a house. Would you panic if someone told you its value changed today? Probably not. You'd likely ignore it, because you're focused on years, not days. Investments are similar. Short-term price movements are often noise. Long-term growth is what matters. Volatility is the price investors pay for higher returns. Without fluctuations, there would be little reward. The goal isn't avoiding volatility. The goal is learning to live comfortably with it. Don't invest money you'll need soon. This rule alone can prevent countless sleepless nights. Money needed within the next few years shouldn't be heavily exposed to market risk. Why? Because markets don't care about your timeline. If you need money next month, next year, or even in a couple of years, a downturn could arrive at exactly the wrong moment. Invest long-term money. Keep short-term money safe. This simple separation reduces stress dramatically, because your future investments and current needs stop competing with each other. Create a do-nothing plan. What will you do if the market falls 10%? What about 20%? What about 40%? Most people have no answer, and that's dangerous, because emotional decisions happen during emotional moments. Create your plan before you need it. Write it down. My investments are for the long term. I will continue investing. I will not panic sell. I will not react to headlines. Then when fear arrives, and it will, you already know what to do. Nothing. Sometimes doing nothing is the smartest investment decision you'll ever make. The wealth-building superpower. There is one investing skill more powerful than intelligence, more powerful than market knowledge, more powerful than predicting trends. Patience. Patience allows compounding to work. Patience allows markets to recover. Patience allows businesses to grow. Patience turns small investments into meaningful wealth. Unfortunately, patience feels boring. People want excitement. action, constant movement. But wealth is often built quietly, slowly, almost invisibly, until one day the results become impossible to ignore. The ultimate goal. Here's the mistake many people make. They think investing is about becoming rich, but that's not really the goal. The goal is freedom. Freedom to make choices. Freedom to handle emergencies. Freedom to retire someday. Freedom to spend time on what matters most. Money is just the tool. Freedom is the destination. And the best investment strategy is the one that gets you there while allowing you to enjoy your life along the way. Because what's the point of building wealth if you're stressed every step of the journey? If investing keeps you awake at night, remember this. You do not need to predict the future. You do not need to find the next hot stock. You do not need to watch financial news all day. You need a simple plan, a long-term mindset, an emergency fund, automatic investing, and enough patience to let time do its job. The investors who sleep best aren't usually the smartest. They're the ones who understand that wealth is built through consistency, not constant activity. So stop trying to control the market. Focus on controlling your behavior, because when you do that, you'll discover something powerful. The less you worry about investing, the better investor you often become. And years from now, your future self won't remember every market crash. They'll remember that you stayed the course when everyone else panicked. And that decision could change your entire financial future.